do. We have Rami Hamady on the call with us today. We're going to be hitting on mortgage protection coverage and essentially just, why mortgage protection. So I'm going to stop my share and make sure Rami's good to go with me. All right. And Rami, I got you with me?
Yes, I'm right here.
All right, perfect. And Rami, just to kind of hit the call off, for those people who are on the call that maybe haven't had the chance to hear from you, tell us a little bit about yourself and what got you into the insurance industry.
Yeah, guys. So I'm from Boston, Massachusetts. As you guys know, I work here in the Northeast. I'm with Marisa Christina in the office pretty much every day. Now, guys, I mainly came in the business in the healthcare field, so I came in part-time to full-time. And what really helped me, kind of get into the business and work fast was mastering a single concept. And to me, guys, that was mortgage protection. Now, when I first came in, I was just handed a stack of age to these guys, 1, 2 years old, and was like, "Here, go dial." So that's all my background really is, guys, in sales. I don't have much experience in it. I came from the healthcare industry. So when I came in the business back then, I came in 4 years ago. This is my fourth full year in the business, actually in the fourth year. So then it was a lot of all face-to-face, in-home field sales with mortgage. So I worked a little bit of final expense planning, a little bit of mortgage protection. And at that point, I loved it. I felt I was helping the family in the house, make sure they don't lose their, home to foreclosure, probate, things like that. So overall, that's kind of what got me in the business, and I loved it ever since.
Absolutely. And you talked a bit about mortgage protection, Rami. So you came in, you got started on mortgage protection. We were face to face at that time, so to say, in the field, right? So things looked a little bit different, but you still carried that into the virtual world. And I think a lot of people kind of left it behind, so to say. What were some of your reasons as to why you did want to carry that into the virtual world, coming from in the home to telesales?
So again, I love mortgage protection, guys, and I really mean that. I'm not just saying that. A lot of people, they tend to say that direct mail is like a dinosaur. It's out of age. There's no supply and demand. If you guys all think about it, we all have a house, right? Or we all live in somewhere. We're trying to attain a house at one point. So I always knew that. So I knew that, that wasn't going anywhere. And I noticed that on the phone, it's the same concept, guys. Is making sure that the lead that the person it needs high intent lead, they get letter in the mail, they fill it back out, they go online, fill it that lead. It's the same concept. It's a family looking for help. And now for me, I realized that, there's a good availability of mailers in my area, and going virtual, I can now dial more states, have the ability going back Central Time, Western Time, et cetera, to California, PST, CT. And that makes it much easier, guys, to dial. Because thinking about it, if I could only contact in mass, which was face to face, I couldn't buy a stack of leads in California and go take a flight. I could have, but it would be, tedious. It would take time, travel trips. No, thankfully, I don't have to do any of that, guys. I hopped around the phones, and right off the gate, I knew that a mortgage lead, again, is a very high intent lead first and foremost, but most importantly, it's who doesn't want to protect their house when they buy a house, guys? It's like when you buy a property, do you want to give the bank, 10%, 100K, 200K, and say, "Hey, I'm all set"? No, you want to make sure you protect that income. So to me, I realized that mortgage protection had a better, for me, demographic I was trying to reach. The target audience is the audience I want to speak with. So that's why I stuck with mortgage protection on the phone.
Absolutely. That makes sense. And for those people out there that maybe they haven't worked mortgage protection just yet, maybe they don't know what it is, maybe they're intimidated by it. What is mortgage protection, Rami?
So all it is, guys, it's a family who bought a house, recently financed, or if they're online Facebook, they could have bought the house 10, 15 years back. But it's a lead that basically, again, refinance the property, purchase the house within the last 2 or 3 years. They're looking to protect that loan. They want to make sure that when they die, when they get sick, if they become disabled, they lose their income, they have something supplemental they can fall back on where they know that, hey, my family's protected. Who wants to lose their house? Again, guys, no one wants to go through foreclosure. Nobody wants to ask a family to borrow money to pay down the bills. Nobody wants to sell assets just to pay off an asset, right? And technically, a mortgage isn't really an asset because it's a liability. It's taking money out of your pocket. So with that being said, I kind of really, locked in on that concept per se. And I really just understood that, hey, it's a family that really needs that protection.
Absolutely. And, Rami, one of the things that, you really lock in on, and we can, touch more on this in just a second is, guys, loss of income. We have to realize when we're sitting down or we're talking to people, no matter what the lead is there's going to be some type of loss of income or discrepancy, so to say, should something happen to that individual. That's really what it comes back to. Now, Rami, with that being said, what are some of the key principles that you think people should know who maybe are looking into work in mortgage protection?
So you guys should understand what the lead is. So if you're working, Facebook internet, no, it's based offline. If you're working a mailer, know it's a letter that came in the mail. Those are the first two things you have to understand, because a Facebook lead is different than a mailer. Now, I do mailers. What's that mean? I pay a vendor per piece of mail, like per legit piece of mail, to drop 1,000, 2,000, 3,000 pieces in these territories, in these areas. Now, in those areas, maybe 1% of people send it back in the mail. So I'm dropping again like 5,000, getting 1% return. Now, think about it. If 1% send it back in, how high intent would they be? They should be, pretty high intent. So that's the kind of route I went. Now, when you're doing mortgage protection, the concepts you need to know, the principles per se, is when you're doing an online lead, it's more turning that curiosity into intent. They're scrolling, they see an ad, they may not really know they need it yet, but they're interested. Whereas the family who just bought a house 30 days ago, they know in the first 90 days, they're more open to protecting that property. They want to add the homeowner insurance. They want to add, the solar, everything under the sun to make that property a complete puzzle per se. So when I'm doing direct mail drop, I know that that family, when they get the mailer, they're like, hey, what if I do die? What if I get sick? So the first thing you guys need to know is it's a family needs help, whether on Facebook or they're going to be a mailer. Now, when they're a mailer, have the thought process that they understand what they're looking into per se, right? Like they understand that, okay, this is meant to pay off the house. Online, you have to do more digging. So be proactive versus reactive. So we'll go through it later on, but there's a role and purpose everyone should have. You guys do that with veteran leads already today, or any type of lead you're working. You preface the conversation before it's happening. You're walking the client through what they're going to do and what they should expect. So I recommend everybody, for mortgage protection in particular, to understand what that looks like. We're going to talk about the mortgage. We're going to talk about your health, your income. We're going to make sure it's affordable. We're going to make sure you can qualify for it. Your guys' job today is to make sure it stays in your budget. So those are the key things you guys need to understand in the beginning, is really understand the lead type of working, online or as an actual direct mail. You have to understand the role and purpose. And you guys should know a little bit about how mortgages work. Probate, right? Like Marisa said, income loss. If somebody loses their income, do you think that they can maintain the same household income that was one time 10,000, now it's only 5,000 because I had a heart attack and now I can't work anymore? I'm not dead, but I'm still alive, but I can't work. Now all that income that I brought into the household slowly is dwindling. All the retirement, all the savings, that goes away, guys. So keep those concepts in your mind. Income replacement, probate or asset protection, and understand again that at the end of the day, they need it, right? So understand that the thought process and translation should be, it's not, how much coverage do you want? Mortgage protection, guys, or insurance isn't about paying off the property. It's about making sure that when they get sick or die, they don't get foreclosed. They don't lose that house. Some families I talk to, guys, they get, equity rescue, years of payments. I have families who are healthy like a baby. They get a 15-year program to make sure if they pass during the first 15 years, when it's all tax and interest, that family is okay. Know that the first 15 years of a mortgage is highest at risk. Why is that? Tax and interest. You all have mortgages. When you pay down that loan, you see your principal go down bit by bit by bit in the first few years. There's a reason for that, guys. So keep that in your mind. You guys should know that. And most important, the concept that Marisa taught me, full payoff, partial payoff, and of course, critical period, or we call equity rescue. You should really know those things before I go into talking about a mortgage, because if you can't be proactive versus reactive, you're not going to be able to guide them. They're going to get very confused. Now, if you can't pitch, a 6-year-old the concept of equity rescue, you're not going to be able to sell a mortgage. So definitely get those concepts down, understand how they work and what they're meant to do, compared to how much a dollar is. Think, okay, what does it do for the family? This is act as income, college tuition. It's going to be a wedding, a down payment. So think of it like that. Think of not what the coverage, is, but what it can do.
Absolutely. And Rami, when you talk about, essentially like those three concepts, right? Because like, guys, just so you guys are tracking with us, final expense is a concept. We're using whole life insurance to cover somebody's final expenses, right? Mortgage protection is also a concept, right? So sometimes we're using term life, sometimes we're using an IUL, but sometimes we're using whole life, guys, to cover this type of person, because it depends on age, health, everything else is always taken into account. So with that being said, Rami, those three concepts of essentially that full payoff, which is exactly what it sounds like, that partial payoff, and that critical period, of those, Rami, in working leads day to day, what would you say is the most common concept you're using to help that family?
I would say probably the critical period equity rescue, to be honest. Majority
And
of people looking at are probably older.
exactly. And with that being said, like, what does that mean to you? Critical period equity, when do we use that?
Yeah, so I'll go through all three of them guys for you guys. And Maurice, you won't make them role play the equity rescue part to make it a little bit, make more sense.
Yeah,
But
definitely. So guys, like rock with us. There's three concepts. Rami's gonna hit on them right now.
so a full payoff is exactly what you guys think it is, right? It's 100% of the mortgage covered. The second type is called a partial payoff. That will cover part of the mortgage. That could be anywhere from 1%, guys, down to 99% of the mortgage. Just not a full thing. It's just if they can't afford it, they don't need it. Maybe they have insurance in place that can act as mortgage protection. You don't always have to pitch the full payoff. So let them know that. Say, hey, we have something called a full payoff, then a partial payoff. Now, Maurice, the third type of program is called critical period equity protection. It's in the critical period of time, guys, when the homeowner passes away and the remaining survivor of the marriage, the surviving spouse or surviving next of kin, the son, the daughter, etc., has enough monthly mortgage payments covered where they're able to pay the bank month by month, not default on the mortgage, most importantly, have time to bury their family, have time to properly grieve, but then now see what kind of assets they receive through the estate transfer. See how much income and pension, social actually goes under their name. Now, at that point in time, they can decide, can we actually stay here feasibly? Can we maintain this mortgage? Or are we going to have to sell the house and or we have to sell the house and seize the equity? Now, if you guys think about that real quick, a lot of you probably talked to an individual where they were 70, 75, 65, and they told you I need $500,000, I need $1 million, and they have no life insurance. They have no insurance or any protection in place whatsoever. They might have a 401k, they might have an IRA, but they had nothing. And I'm sure you guys walked away from that because you didn't know how to convince the guy of the value and the need. But think of it like this. If we all had a crystal ball and we knew the exact day we were going to die, all of us, and you knew there was a small chance, even a 1% chance, that if you died today, the bank can call your family tomorrow and say, hey, listen, you don't make enough money. We don't feel comfortable you staying here. We gave you a 30-year mortgage. You died in year 5. We actually might want to contest the will. We know you're leaving it to your kids and each other, but you make $1,000 social. You might have more income after everything settles, but we're not going to try to contest your property. Imagine that wife having enough time telling the bank, no, I have 2 years of payments covered. I can pay you guys for 2 years. The bank's going to say, sure, no problem. Because to the bank, you're paying my money early. You're going to continue to pay me. And if you default on the mortgage, if I'm the bank and Reese is paying me that 2 years, I'm thinking one of three things. A, continue paying my loan that I gave you, the money I want. Great. You're paying my interest. Awesome. If you default and you can't make the payments anymore, you just gave me 2 years of free money for free. That's it. Now the bank can have more equity and foreclose. So to the bank, they're actually happy to see that. They want to see the payment's going to be there. Now, in reality of it, it's not to less for the bank and take the house. It's so the wife can have peace of mind. She never looked at, have you guys hear me say the coffee cup analogy, but I'm serious. Like you never want somebody looking at their cup and thinking, how the F do I pay my bills? How do I handle this mortgage? How do I truly bury my loved one? So that equity rescue, that small 1 to 2 years of monthly payments is going to bridge the gap. They used to call it a gap plan. It's going to make sure that when they do pass away, in the first 12 months of payments, let's say the first 3, they do the cremation and burial. The next 3, they talk to the SSA department and they say, all right, how much can I actually get from my husband's passing? Well, the social transfer, pension, the whole 9. Now, the next 3 months, that's a 9-month timeline. They're actually going to talk to the bank and see, can I stay here and pay this monthly mortgage payment month by month without going through a burden, without making it hard for the next 10, 20 years? Or am I going to sell the house and avoid probate and just take my equity? At that point, it's on the family's time, not the bank's time. And you don't know how many times, guys, that one sentence, it's on your time, not the bank's time, has saved so many sales for me. Because I've talked to so many individuals, high net worth, who have insurance, who already have things in place, $1 million estate. But at the end of the day, they understand that when they die, life insurance is the fastest, most immediate form of payment upon death, outside of cash under the mattress. They got millions tucked under that mattress, different ballgame. But not everyone has cash like that, guys. And as we know, cash is, dwindling. Cash is king. So I know that when that family gets those payments, it's going to give them that, that breath of fresh air. But the one thing before we go into those concepts, guys, you guys should understand that there's homeowner insurance. It protects the property itself. Because a lot of people will say, I have that insurance. I already have it. Don't worry. I'm taken care of. Homeowner protects the property, fire, flood, tornado. The second type is called PMI insurance, or MPI, depends who you ask. But that PMI protects the bank. That's to make sure that you did not pay 18, 20% down. Your debt to income ratio isn't sufficient or solvent enough to keep the house. So the bank makes you pay an insurance premium, where if I do die, the bank can buy back that mortgage. Once you meet that evaluation of 18, 20%, they waive it. You don't need it anymore. The third type of protection is what we're talking about today. It's here to protect them, not the bank. So keep that as one of your guys' mind, because when you start going over those three concepts, the other concepts you should guys know is homeowners, PMI, and what we're talking about today, life insurance to protect a mortgage, or AKA mortgage protection.
Absolutely. So, essentially, guys, that one liner also got me a lot of sales and helped it just kind of click for the client. It's on your time, not the bank's time. Nobody wants to do anything on the bank's time. Like, I know I definitely don't want to do anything on the bank's time. Not today, not tomorrow, not ever. I'd rather do it on my time, right? And most families that's gonna hit with them. It's gonna resonate. Rami hit on a lot of key things, like life insurance is the most immediate benefit that's going to pay out. Guys, somebody could be like filthy rich, but something isn't set up right. And the way that the courts move, they just move at their own pace. It doesn't matter. And they could lose everything because things were not set up properly, even if like they were set up properly. Guys, I lost a great uncle. He was hands down the smartest person I've ever met. And like his stuff was set up properly, but it still took 2 years to pay out. Now, should he have had a wife, that person wouldn't have been able to wait for those assets to transfer over. So that's really what we're talking about today, guys. Now, the reason why we're gonna hammer on critical period, guys, is because it's the most commonly confused concept out of the three concepts. So, Rami, hit us with kind of a full payoff when that makes sense.
Yeah, so full payoff, guys, is it's like when researchers told me life insurance is an upside down triangle, and I mean that. So the upside down triangle is like a funnel. When you're young, 18, 20, maybe 30s, I'll say low 30s, you need a large amount of insurance, right? You have a mortgage, you have college tuition, you have debt, etc., right? You have all this debt that or an income that needs to be covered while we're young and still working, having that ability to make money. As you get older, your ability to make money should strengthen. You should, have more liquidity, which means you should make smarter financial decisions moving forward. With that being said, you have a better retirement. You're knocking down your debt faster. You're not having all these outstanding burdens left behind. Now, in your 50 and 60s, that term policy or the full payoff falls off because, guys, we don't know whole life. The ones we work with, particularly, are simplified issue products. We don't have things that go up to 400, 500K for whole life. Some carriers, but 99% of us understand that Eagle, Living Promise, Sendo, the whole nine. So in order to kind of help that family out, you understand a mortgage term is 30 years, 30-year term, maybe in a 15 or 20, depending on income, depending on the need. Don't automatically think 30-year mortgage means 30-year term. That's the easy way to think of it, but there's more ways to actually explain it. But that's when the full payoff makes sense, when they're young and they need it. As they get older, that's when the partial makes sense. When you're 45, when you're 50, I give you a 15-year mortgage. That's the age 75 or 65. I'm covering you all the way to retirement. As you're working and generating that income, I'm making sure you get sick or pass away, you have money. Now, once you're retired, and like I mentioned, your bills are more fixed, your income is more steady, you don't need the insurance, that falls off. That's where that partial payoff kind of comes in. And the critical period is one that we all run into all the time. Heart attack 10 years ago, a stroke 15 years ago. I had cancer back in 2001. Even though, guys, it's more than 24 years back, it doesn't have you ever question. They cannot get term insurance. They cannot get an IUL. So at that point in time, we have to pivot to equity rescue. And that's using, guys, a basic whole life vehicle like we're going to go through right now to give them monthly payments. An easy example would be $10,000 and a $1,000 a month mortgage. That's 10 payments. 1,000 times 10. That's 10 months of payments. So we're going to go through the concepts, but the full payoff, guys, when they're young. The partial payoff is when the homeowner is 50-50. Income, guys, is really important to know because if I make 5,000, Marisa makes 5,000, that's 10 together. If our mortgage is $1 million, she can cover 10,000. She can cover her half of the mortgage payment. She needs my half to be replaced if anything happens to me. That's really where you guys use that partial payoff concept where the income is more 60-40, 50-50, and you don't need that full thing covered because they're paying down the mortgage every single year. It's going to get less. And B, typically the ones looking for that are younger. So again, they don't need all that protection. It's typically as you get older, that's a sweet spot where I love using the critical period program.
Absolutely. And guys, this is applicable, critical period is applicable for people who are over the age of 75. It's applicable for people who, had a heart attack a year and a half ago. It's applicable that's when this is coming into play, guys. So we're gonna role play an equity rescue, type scenario. Rami, we can make it as simplistic as possible just to, do that easy across the board. And I'm gonna be 71-year-old, whoever you want to call me, Rami, and I'm looking to protect my kid if something happens to me. I want to make sure they're okay with the home.
Okay, got it. Now, how much is the mortgage payment at this point in time?
The mortgage, we're gonna make it easy, is 1,500 a month.
1,500, got it. So guys, now assuming we've got through the, do you want me to do the whole presentation or?
Yep, let's just do it. I think it will be good.
All right. So do me a favor, grab your pen and paper.
Yep.
I write down my first name for me, Rami, Rami. My last name, Hamady, Hamady. I'll take down my NPN. It's like my business social, guys. It connects me to the Department of Insurance Registry. It's called my national producer number. That number is 199-63802. Then Maurice, is this a cell phone where I can send you a text message to so I can send you my credentials?
Yes.
Perfect. I'm going to send you over a text message on my mass driver's license. I'm going to send you over my mass insurance license. It's on the top rated companies available to you today to protect the mortgage. Did you get that yet?
Yep, it just popped in.
Perfect. So now, Marisa, on first and foremost, guys, I do say this. Do you want to verify me on the DOI, Department of Insurance? We're going to be talking a lot of sensitive things such as death and finances. I just want to make sure that whenever we're going through the application process, you know exactly who you're talking to. Do you want to look me up or do you feel comfortable to begin?
Yeah, if I could look you up.
So guys, all that is Google, Marisa. Go on Google for me. All right. Type in Massachusetts Insurance License Lookup. That's all it is, guys. Get to the DOI website, your state website. Click on that, insurance providers and producers. Once you get there, Marisa, let me know. She'll tell me, all right, it should say on the very top, this is a government official website of the Commonwealth. Please verify on the very top. You see this green bar just to make sure it's an actual government website.
Yeah.
Perfect. Now I want you to click on that link where it says look up producer status. Guys, then she looks me up on the SBS, on the insurance registry. Let's say she looked me up, she verified me. All right, Marisa, so I'm going to explain to you what my role and purpose is today and what I'm here to help you accomplish. I want to refer to as a mortgage underwriter or mortgage broker. All that means is I work hand in hand with 85 top state regulated companies to protect you and your family. I work with you, not against you. I do the shopping for you. Think of me like the eyes and ears of the insurance company. So what we're going to do today is talk about three main factors to get you the best rate possible to protect the property. In order for me to see which are the top rated companies, I'm going to ask you about the mortgage itself to see how it's structured, how it's set up. Then I'll talk to you a little bit about your finances, about life insurance, and things you currently have in place, as you may not need as much insurance as you truly think you do. I'll be the very first person to tell you that. Does that make sense?
Yes.
And secondary to that, Marisa, I need to make sure anything that you put in place today meets your needs and budget. Does that sound fair?
Yeah.
And last, I'll talk about your health, okay? Not to be invasive by any means. I just want to make sure any application that we submit today, I get you approved and not declined. Does that make sense?
It does.
Your job today is to help me help you. With that being said, you got a budget, I got a budget. Noah, Blake, Rance, Jesse, Brian, Christina does. Let's make sure anything you put in place today meets your needs and budget for your family, okay?
Okay.
All right, now we'll take 1 to 5 days to complete the application. It's not like buying a loaf of bread where you're like gonna buy it. You have to qualify for this. So my job today is to send the initial request to the insurance carrier. Once it goes there, it's gonna take about 5 business days to render the final underwriting decision. At that point in time, you'll get the policy in the mail. It's effective day one coverage, and your house is protected. Are you ready to begin?
Yeah, I'm ready.
Perfect. Now, Maurice, I know your mortgage currently on. What is your outstanding balance at this point in time?
It's about 250.
Now, Maurice, so before I continue, do you mind if I'm very transparent with you today? I'm really honest. Some people tell me really blunt. Do you care if I'm as direct as I can be?
No, I'd appreciate that.
Perfect. I'm not here to mess around. If I think you need it, I'm going to tell you what I think you need it. All right. And is it 30 or 15-year mortgage?
It's a 30-year.
30-year. And what's the monthly mortgage payment today?
It's 1,500.
Okay, 1,500. And what's the interest rate?
It's about 3.1.
3%. Do not refinance anytime soon, okay? That's a great rate.
I'm not gonna.
All right. Do you make any, what's your house appraised at today? What can you sell the house for if you needed to?
If I needed to, probably like, I don't know, it was last appraised about 550.
550. Great. So the equity built on the property. That's amazing. And now, Maurice, did you pay extra to knock down the mortgage to pay it off any early?
No, I don't.
And what was the first original balance again?
The original balance is 250.
So you got 300,000 equity. Well, first and foremost, Mrs. Maggio, I want to congratulate you on that. That's amazing. You worked very hard for that income. That's your down payment, your mortgage payments, renovations. Every family understands the need to protect their equity. Does that make sense?
Yeah, it does. I worked really hard for it.
I agree. Now, Marisa, God forbid anything happened to you yesterday. What does that look like? What does that look like for you today? Who will be your beneficiary on the policy? Who's picking up the pieces? And God forbid you passed yesterday. How are they going to handle the mortgage today?
Yeah, I mean, that's kind of why we're on the phone. I want to leave it to my daughter. I just don't know if that's possible, really.
Of course. How old's your daughter?
She's 32.
Yeah, there's no problem. It's above 18. That's fine. And quick question, Marisa, are you on the title and deed of the property, title and loan?
Yes.
Are the only borrower on the property, or do you co-borrow?
I know, it's just me.
Did the bank take their time to explain to you, God forbid you passed away, what that actually looks like for you and your property today?
No, they didn't.
All right. Well, in the event, Marisa, if you died today, think of it like this. The bank, they own your property. You're financing that loan because an asset to the court adds money to your pocket, a liability removes money from your pocket. So as you're paying on that mortgage, it's going to be a liability because you're paying them back income with interest. Now, if you pass away, that means your loan dies with you because it's your social history of income and cash flow that maintains that property, that keeps it afloat. Now, the bank, they see your statements. They know exactly how much you make. They know what you bring into the property. Now, if you died today, your daughter would not be able to take the house right away because the bank, unfortunately, they hold the first say of the property. It's called a transfer of deed or transfer of assets, a TOA. In order for that to transfer, it has to be paid off. So what's going to happen is the bank is going to contest your will through probate. Now, what probate means is this piece of paper that I've written down right in front of me, they're going to tell me that it's not written properly because they want to seize the equity of the property. Right now, you told me you owe 150. The house is currently worth 550. That's $300,000 the bank can seize and sell it to the next buyer. So I assume you're like most families and homeowners, you want to make sure that God forbid you died yesterday, nobody can take the house from your daughter tomorrow. That she's able to take the house over. She decides if she keeps it or she sells it, and the bank can never foreclose your property.
Yeah. That would be great if they couldn't.
Okay, that makes sense. Just keep in mind that 78% of houses enter foreclosure because of death of the main borrower or co-borrower or death of the major income earner. So I definitely see why you filled the request out. Now, Marisa, what do you have today that acts as mortgage protection?
I have some life insurance, but that's about it.
So nothing for mortgage protection.
No.
Okay, I see why I filled it out again. And who's the life insurance company that you're sponsored with today?
I have Transamerica.
All right, and is that a term life insurance or is that a whole life?
It's a whole life. It's just to cover my final arrangements. I've had it for, over 20 years now.
So for this part, guys, I'd have her go and grab it just to review it. Now, I say, Marisa, grab the policy for me. If it's the best policy on earth, I'm going to tell you it's a good policy. I just want to make sure I can document for your file what you adequately have in place already. So I'm not going to touch on it, guys, for this conversation, but I make them all grab the policy because you're taking control. You're being assumptive and you're making somebody stand up, walk to the room and grab a policy. It means something when they can do that. If you're asking that question and they'll always tell you, no, I don't want to get it, or I don't have access to it, not right now, they're BSing you 90% of the time. They have it. They all know what they got. They know where it is. They just don't want to get up and follow your direction. When they do listen to you and they follow your direction, you're in control of the conversation. Now she tells me the insurance. I write it down. I'm going to hammer again and say, okay, so just a reminder one more time. There's nothing that acts as mortgage protection. You have a small life insurance policy to cover your burial cremation, but nothing to make sure your daughter Christina's going to be okay if anything happens to you.
No, I just have my retirement, things like that, but that's not for the mortgage. So no.
Exactly. And those items, guys, can be probated. And I would explain that. If she didn't say that, I would say these are probatable items. All right, that makes sense. So I understand why you need it. And your beneficiary is your daughter, okay? Do you have a will put in place?
Yeah, I do have a will.
Excellent. And do you have a trust?
No, I'm working on that.
Okay, a trust is really important to have, Marisa, because think like a suitcase. It puts all your assets in the suitcase and you put a trustee on it. That's someone you trust holding your assets. When you die, the will's in there. There's an executor. They're going to execute the will to make sure your beneficiaries receive your assets accordingly. Does that make sense?
It does, yeah.
And guys, the reason I'm saying that is because it's really important to educate the client. The more you can educate them and the more you can explain to them what that looks like, the more comfortable they feel with you. Now, I'm not a sales guy. I'm trying to solve a puzzle. I'm trying to figure out, okay, if they have a trust, I would explain how that helps them and why it actually may benefit them. But if you don't have a trust and don't have a will, that's a leverage you can pull to say, hey, you're going to go through probate. And I mean that. Like, you need a will, you need a trust. If anyone tells you otherwise, they're lying to you. And with just a will in place, guys, everyone in America will put their house in a will. We will never lose our house. Everyone will have a house for generations. Unfortunately, not the case. All right, Marisa, what's your occupation at this point in time?
I'm retired.
Retired. And do you collect Social Security income, disability, etc.?
I collect Social Security in my retirement, yeah.
All right. Are you a veteran?
No.
All right. And now what's your estimated monthly income after taxes? Start with your social after deductions, please.
It's about my social's about 1,000 flat, and then my retirement's about 5,000 flat.
Okay. And you're aware that your retirement doesn't transfer to anybody? It just dies with you?
Yep.
Okay, perfect. And guys, verify that. Sometimes it's true, sometimes it's not. All right, and so Marisa, you have $1,000 through social, $5,000 through your current pension, no mortgage protection, small life insurance policy to cover your final expenses. All right, and now talk about your health. Any major health concerns, heart attack, stroke, cancer, because I see why you need it. You're like most homeowners. You don't want to burden your daughter. You don't want the risk of them seizing the equity, so I understand that. But talk to me about your health. Do you have any major health concerns, heart attack, stroke, or cancer? Have you ever?
Well, they called it a mini stroke, they said, but I don't think it was a stroke, but that was like 3 years ago.
They called it a mini stroke. Okay, and that was 3 years back. Now, any complications due to the stroke or mini stroke?
No.
Okay. What medications did they prescribe you right after the mini stroke or TIA occurred?
I take Eliquis.
Okay.
Um, I take lisinopril.
Okay.
Type 2 diabetic, I take metformin
Uh-huh.
and atorvastatin.
So you're a blood thinner, a little bit of high blood pressure, type 2 diabetic, and you take a cholesterol medication. All right, Marissa, do me a favor. Do you mind standing up and grabbing all the medications you're currently prescribed at this point in time? Not just the ones you took in the past, but everything you're currently taking today.
Yeah, sure.
All right. What are they?
Right. The only other one that I missed is I use an inhaler. I use albuterol as needed for asthma.
Okay. Do you have any diagnosis of COPD or seasonal allergies?
Seasonal allergies, but no COPD.
Perfect. Okay. And regarding the blood thinner, any diagnosis of congestive heart failure or coronary artery disease?
No,
Okay. And have you ever been hospitalized due to your diabetes in the past 2 or 3 years?
no,
Has your A1C ever been over, is A1C your hemoglobin level, have it over 8 in the past 6 years?
I don't believe so. No.
Okay. Any complication of diabetes, ketoacidosis, neuropathy, retinopathy, any amputations, numbness, tingling of the feet, things like that?
No, it's pretty under control with the metformin in my diet.
Amazing. So with diet and exercise and a little bit of medication, it's managed. Okay, great. And now with the blood thinner, one more time, just when was the last time you filled out? You're still taking it? Because you told me for the TIA. Are you still taking it today, 3 years later?
Yeah, no, I do still take that. They say it's like, maintenance.
Medic preventative. Okay, that makes sense. And again, they make me ask some silly questions out loud, so I'm just gonna read this out loud to you. I know you told me about the stroke, but no heart attack, no cancer. There was a mini stroke with TIA, no heart disease, no heart failure, no dialysis, no kidney disease, no liver disease. You said no COPD, but a little bit of asthma, which you need an inhaler. Do you have any overnight hospital stays in the past year for more than 2 nights?
No,
Okay, and any nursing home visits or hospice care or home health care?
no,
And you're not confined to a wheelchair or bed or anything like that, right? Because I can't see you. You're not confined to a bed.
no.
All right, happy to hear that. All right, Marisa, you're a pretty direct case. Like most homeowners, like I said, you want to make sure that when you pass away, your family's gonna be taken care of. They're not gonna be able to lose all that equity it took so long to build in the house. Most importantly, again, you don't want your house to be foreclosed, right? You want your daughter at peace of mind, knowing that she gets a check when you die. She doesn't write a check. And most importantly, I understand that you don't want her looking at her coffee cup thinking, how do you pay the bills? How do I bury my mom? How do I handle this mortgage? She'll have peace of mind, understand that the mortgage company or insurance company will pay the mortgage for you, and your money and her money can stay in her pocket, and there's no longer have to pay the bills. The insurance company pays the bills for you. Your money stays your money. Does that make sense?
Yeah, it's making sense.
All right, grab your pen and paper for me. I want you to write these 3 things down.
Okay.
So there are 3 types of mortgage protection programs. The first type is called the full payoff. That's going to cover the full mortgage. Now the second is going to be a partial payoff that covers part of the mortgage. Now the program we're going to be looking at today is called critical period equity protection. It's in the critical period of time when the homeowner passes away. The surviving spouse or remaining next of kin has enough money to pay that mortgage payments, where they avoid probate and they avoid foreclosure, where they're able to pay the bank month by month. And at that point in time, they can decide, do they have enough income to stay in the property and maintain the household, or are they forced to sell the household and rescue or aka save the equity? Does that make sense?
Yeah, it's making sense. So in other words, this would allow my daughter to keep up with the monthly mortgage payment for how long?
Do me a favor, you jump ahead of me real quick, but jump get a pen and paper and write
Okay.
this down. Your gold option is going to be 30,000. Your silver option is going to be 20,000, and your bronze option is going to be 15,000. So what I
Okay.
do, Marisa, is how I explain this to the homeowner. It's not what the program does. It's not what the dollar is. It's what it does for the family. I take the 30,000, I divide it by 1,500, your mortgage payment. Your gold option will give you 20 months of payments. So under the 30 or gold plan, write 20 months in big bold writing.
Okay.
Under the 20,000, I want you to write 13.3 months. And under the 15,000, write 10 months.
Got it.
So how this program works is we're going to have, what was the first one again? 20 months, 13.3, or 10 months of time for your daughter, Christina, to make sure that if anything happens to you, she's able to handle the mortgage. I'll give you a little example of how this works. So let's say you end up picking the 13 months of time. What's going to happen is you're going to set aside a monthly payment to guarantee peace of mind for your daughter. When you pass away, she's going to receive a lump sum payment of 20,000. Now that 20,000 is 13 months of payments. During the first 4 months, she's going to mourn and grieve you. They're going to properly handle your estate. During the next 4 months, they're going to understand how much income do they have. Can she afford her mortgage? Can she afford your mortgage? Is she going to be able to keep in both houses or have to sell it? The remaining 4 months of the mortgage of the program, she's going to be able to sell the property if she needs to. At that point in time, she can find a proper buyer. She's not forced to short sell, guys, which is a real life thing. They love to short sell people. She's not rushed to make any decisions. She can properly gather your assets, take all the nice sentimental things she has in that house for herself, and you're able, to keep the property for your daughter. Does that make sense?
Yeah, that makes sense.
Now I'll explain what the policy does for you outside of how it helps your daughter. This is where I go into what it does, guys. I say permanent coverage doesn't expire. It's a tax-free benefit. Your price will never decrease. Your insurance amount your price will never increase. Insurance will never decrease. If it's AIG, I go into nursing home confinement, terminal illness, and the chronic illness rider that it carries. If it's SIWL, if it's a Americo, I talk about the double accident feature. I'll talk about how it builds cash value. I say, so Maurice, it's going to build cash value. Now, all that is, it's interest the insurance company is going to give to you. Now, it starts building after the second year. We do not recommend anybody to borrow against their policy in the early years, because if you take from the policy, you're going to give Christina less amount of time. She's not going to have as many months of payments covered for the mortgage. But the reason I'm telling you this is because as you get older and the cash value compounds and grows, you're able to borrow against it if you need to for some life expenses, or just keep it there and understand if you need the policy, you can always access that cash value. Does that make sense?
Yeah, that makes sense.
The terminal illness is important to know because in the event you get terminally ill, you have access up to 50% of the death benefit while living. You don't want to be sick, guys, and having to pay an insurance premium. You want to make sure that if you are sick, you can get your rates in a row. And guys, when they're younger, I love the 40 and 50-year-old for the mortgage protection equity rescue because they outlive the mortgage, guys, and like a lot of times. And when you're 40, 20 years out on the mortgage, now you're 60. Now the policy is life insurance. So I sell so many people when we said what's your main demographic, really thinking about it, 50 and 60s, because they have 20, 15 years remaining. I cover that gap to make sure they're okay. At the end of it, they can liquidate the policy, surrender the cash value, take all of it back. Or now it's life insurance, kills two birds, one stone. All they have to do is not die during they have the mortgage. And they have work insurance in the meantime. They have all these extra supplemental insurances that if things do happen, they're okay. They need to make sure that after all that, when they're like 65, 70, what's in place. So it's really important for the young people as well to tell them it's two birds, one stone. It can be life insurance and it's going to act as mortgage protection, assuming they outlive the mortgage.
Love that.
And then that's how I explain to guys. So I say, lastly, peace of mind. It's a tax-free death benefit upon death. And if I feel the family's pushing and they're acting like wide ass, I just do common sense logic. I say, Marisa, all right, let's say the 30,000 costs $100. I say, Marisa, do you save $100 in your bank account every single month?
Yeah.
Now, if you put that money in a bank account, even a high yield saving, that's around $1,200 a year, right? Plus or minus 10 or 20 bucks, right?
Yep.
Now, if you pass away in the first year, how much money do you have saved in your bank account?
1,200.
There we go. Now, in 10 years, how much do you have?
12,000.
In 20 years, how much do you have for your family?
24.
The $30,000 policy is $100. So would you rather put your egg in the basket where God forbid you pass away any day from now until 20 years, you have more money than you have saved? Because I know that 30,000 is more than 1,200. So it's a monthly payment that brings a large lump sum. So we would rather put that money in the place where in 20 years I have 24,000, or I can die tomorrow and $100 became 30,000. That's the way, guys, you're able to explain allocation of income. If they save already 200 bucks a month, or they pay extra towards the mortgage, $100, $200, $300, $400, that's money you can allocate to a policy that pays off the mortgage. If Marisa was younger, let's say even at 60, and they're paying 1,000 extra a month, where I've seen that before, I say, hey, I do an IUL. I'm like, hey, let's overfund an IUL a bit. Let's, if they're healthy enough. With America's now, we can kind of custom it so they have more cash value, but build it where it protects them for 15, 20 years. They cash it in and they pay it down to the mortgage early, and they save those years of time. So it all depends on, how you think of it. And again, no bank is going to guarantee them entry to the stock market, and no bank will take 1,200 and make it, 100,000, 20,000, 10,000. So always use their income against them in a way of no bank account you have is going to bring this death benefit. So while we're arguing about making $100, 10,000, even guys, if it's a $5,000 policy at 200 a month, that's typically people who are older in their 80s, and times of the essence, time's ticking from the fourth quarter. So they could die tomorrow. So I'd rather know that I want to put my money to a place where it's going to, 10 times, 50 times, 100 times, whatever the case is, compared to sitting in a place that has the potential to be frozen, a potential to go through probate, or even the idea of giving my family a burden. Like, I don't want the family to have to feel the need. They need to burden loved ones. I want them to know that they can put a small payment aside, 100, 200 bucks, and guarantee their family peace of mind, even if that's, again, 6 months of payments, guys. Because I know for all of us today that if our parents died today and we had 6 months of payments to cover the mortgage, none of us would be upset. We're going to be happy and thankful that somebody took the time to explain a whole life policy in that way. That you didn't just walk over them and say you don't qualify, or you're 75, you can't afford a full payoff. They took the time to explain to them why time really matters.
And guys, I think there's two ways you can look at the equity rescue critical period concept. You can say that doesn't make sense. It makes perfect sense. It's been making sense for me for the last 9 years. So it definitely makes sense. Makes sense to a lot of my clients, and it's definitely the heaviest used product within mortgage protection. If you think you're going to get mortgage protection leads and they're all going to be 32 years old and healthy, like, you're very heavily mistaken. That's not what your lead flow is going to look like. So you have to have the expectation of, how do we break this concept down using life insurance, like we're using, whether it's term, a full payoff, a partial payoff, or it's an IUL, or we're using a whole life product, again, to temporarily cover something. Guys, when push comes to shove, when I've been sitting with John and Mary over the last X amount of years, or X amount of homes, or X amount of phone calls, guys, it's a lot scarier of a thought to completely lose the house than it is for them to sell the house. You're going to have that client that's, I don't want to sell the house. I don't want to sell the house. Well, Deborah, I love you. I love you, Deborah. But if you die based off the way the income looks, there's nothing you can do except sell the house at its top dollar and not have to short sell it. Right. So it's like, guys, that's where we're going with this concept. And I love how you said, Rami, educate your clients. There's a few one-liners in there, guys, that Rami used, talking about how 78% of homeowners that have a single name on the title, it typically goes to probate. There's so many one-liners in there that Rami used that you can listen back to this call, or you could have wrote down right now and you can implement them tonight. It's like, these are good across the board, right? These are not things that just made up. It's not what it is, it's what it does. The first time somebody said that to me, I had to like stop and think for a second. Like, okay, wait, 30 grand isn't going to cover somebody's $250,000 mortgage, but it's what it does. It's going to give the kid, it's going to give the spouse the appropriate amount of time to do things on their terms and not the terms of the bank. And also, how Rami told me what I was going to do. Rami had said to me, you're going to set a set amount of money aside to cover this when you do pass on, to make sure your daughter can properly take over the mortgage. He told me what I was going to do, aka I'm going to pay an insurance premium to get this amount of coverage. Got it. But guys, sometimes we say that to our client, it's not making sense. Sometimes it's the way we package it. 99% of the time, it's the way we package it, guys. Does it sound right? Are you stopping to say, does that make sense? And if you're not, and you went through a whole concept and you get to the end of it and your client's like, I have no idea what you're talking about, that's on you. Like, it's on you. Like, that's you. You need to slow down and be like, does that make sense? Rami is hands down the fastest talker that I've ever met in my whole entire life. And he slows it down and is making sure that the client's with him, right? So guys, make sure you're doing that. And the fourth quarter thing. Okay, I want to bring this up because I remember the first time that I told Rami to tell somebody they were in the fourth quarter, and it was like his second appointment. And guys, the reason I bring this up, it's not to be mean. It's because we're in life insurance, guys. We're all going to die, not to be morbid, but we are. We're all going to die, and everyone we're talking to is going to die as well. Period. End of story. Rami asked for permission on the front end to be brutally honest. I told him yes. That's what I would actually appreciate, right? Like I would appreciate him to be 99%. That's what they're looking for. Can I trust you? Are you telling me the truth, right? So right off the jump, I'm already trusting Rami because he already asked me that. So at the end, when he tells me, because I'm like, I'm 72-year-old Tina, right? And Rami tells me I'm in the fourth quarter, I'm not taking offense to that. He's just being honest. Based off of my mortality, I'm in the fourth quarter. It's not rude. It's honest. Like, I like to think at my current age, I'm not in the fourth quarter, but we never know when our fourth quarter is going to be. But what we do know is when somebody's over the age of 70, they're in the fourth quarter. So, guys, we got to start allowing them to see that in an unaggressive way, such as you're respectfully, Rami, you're in the fourth quarter. Like, you don't have time to think about this. You've thought about it for the last 76 years. What is there to think about? So, taking those things into consideration are huge. The fourth quarter thing, guys, it sounds silly, but if you can help somebody understand you're just going to be blunt through the conversation, it really doesn't catch them off guard. 99% of the people I tell are in the fourth quarter, they say, I know I am in the fourth quarter. And they usually agree to what they're looking at because it makes sense to them, guys. So Rami, just to kind of tie this concept together and mortgage protection, generally speaking, just to kind of wrap the call, is there anything particularly you feel like you get the biggest kickback specifically with equity rescue or critical period that you think you could help some folks out with right now?
Yeah, the biggest kickback I get typically is like, oh, well, so this won't cover the full mortgage. That's like what they say. They're like, oh, it's not going to cover the full thing. And going back to explaining to him, it's not what it is what it does, right? Mortgage protection is not meant to pay off the property, but avoid the house from being taken or foreclosed. But most importantly, I would say that remind them that the things they think that actually may help them is going to hurt them, like an IRA, a 401k. Look up in your state, guys. Those are probatable assets, literally, like which means they have the potential to go through probate. So when you can tell somebody that, and like Marisa said, how she said, well, my retirement's not it's not meant for the mortgage. Tell the client that. Be direct. Don't be afraid to tell the client when they say, oh, I have a 401k. My wife, when I die, she can get $1 million in there. She can take it. Say, so when you went to work and you worked 60 hours a week and you busted your butt for all that income, you knew in your mind that this is to pay off my $1 million property that if I die, you didn't do it for your retirement. Okay, let's say you take out half of that to pay your retirement, to pay down the mortgage. What are you going to do when you're 65, 75, and 80 when your money runs out? So let them work smarter, not harder, guys. So basically explain to them why it's important not to utilize retirement income, savings, money they want to give behind for their kids to cover this large burden. Instead, explain to them why a monthly payment brings a lump sum. It's a bills that pays the bills, guys. And that's the biggest thing you're going to get with equity rescue is people either saying that, hey, I have things that can kind of do this already, and explain to them where even if they do, whoever died saying they had too much immediate life insurance, and I'm serious. If someone tells you I have a trust, I have a joint savings account, XYZ, they filled the form out for a reason. Go back to that why, go back to why they filled it out, go back to explaining to them that, okay, you have no bank that's going to take this 200 payment and pay you $10,000 tomorrow. Isn't that a good investment? If you died in 1 year, 2,400 for 10K, I'd take a $7,000 gain on 2K every single day if I could. Now, if you tell them that logically, they'll think about it. Say, okay, that makes a little more sense. And you tie it back to what that does for them. That's going to give your daughter and your kids time to go on vacation. It's going to give them time maybe for their wedding. Maybe they use that as a down payment. Maybe when you pass away, they really needed money to pay back some bills and credit card debts and or do a big renovation. And now all this money that we're kind of arguing about where you think you don't need it, it can actually benefit you and your family and leverage your legacy. And always coming back to leveraging one's legacy and just tying it back to a need that all of us want covered. That's what I think of. I think of, okay, in my life, what can I use this money for? I just tell it to the client. And typically, guys, we're all human. We all think the same way, give or take a few aspects. But that's the biggest tip I would say. And just be, guys, you're direct and be yourself. If you're not like, very direct and forthright, don't have to be that way, but be honest. Like if the client thinks, a term life is going to pay the mortgage off, no, but tell them why it's going to help them. 10 years, 15 years covers 10, 15 years of the mortgage. It's better than zero. If they can't qualify and they're 60, 75, 80, they only have a small insurance policy to cover like their final expenses. Explain to them, like this whole call we talked about, how the time means a lot. And always go ask them this question. If you go back in time, would you? They all say yes. Say, okay, so why don't you want to give your family more of it? It's simple as that. Can you go back in time today? No. Would you like to? Yes. Why don't you want to give your family more time then? If we can't buy back time, at least I can give them time through insurance. And that's what all it comes back down to, guys.
Awesome, Rami. That was awesome. Truly. And guys, I took a lot from this call, and I live with Rami, so I hope that you guys did too. And also one thing, Rami generalizes great, and so does his entire group. It could be the most complicated case. You're a pretty direct case. So, but here's what we're
Well, would
gonna
you
do.
say that, guys?
It's
Because they're direct. You just gotta tell them that they're all easy, even the hard ones.
Even the hard ones are a pretty direct case. So if you need like a transitional line when you're on Zoom, unmuted, and you need to put that person on hold, hey, Rami, you're a really direct case. I'm going to just place you on a brief silent hold, and I'm just going to get with my senior underwriter to make sure we're going in the best direction for you and the family, okay? Like guys, utilize the resources you have around you. A lot of you guys are in the Zoom room, which is awesome. A lot of you guys unmute in the Zoom room. A lot of you guys don't unmute in the Zoom room. If you're not where you want to be in this business, that Zoom room, guys, is literally made and designed to help every single person on this call get where they want to go. So start unmuting yourself, start utilizing your resources. I hope this call was helpful. I know it was a great refresher for me, and I help folks with their mortgage protection every day. Outside of that, any quick questions before we hop off? I'll take like one or two if you guys got them.
Rami, do you mainly do whole life for mortgage protection? Or I mean, if they qualify, would you put them in a term and IUL, or is it mainly whole life?
Yeah, it all depends. Yeah, it depends on the situation. It all depends. But I would say typically if they're healthy and between the age of 40 and 65, I'm hoping to get them to an IUL if they can,
Okay.
because this makes more sense. I'll sacrifice less coverage for a better policy because, as you all know, living benefits, cash value, permanent coverage compared to short term. But term is good too. If they don't have the money for an IUL, I'm not going to show that to them. If they make low income, they need to cover the house. I'll do a 15 or 20-year term and explain to them why they need it, and they understand that. It's all case specific.
Thanks, man. Appreciate it.
And I work mortgage mailers, guys. And wonders, I do mail drops. Okay, so I do mortgage mail drops and vet leads.
All right. Well, Rami, thank you for taking the time. I mean, the
Thank
day
you,
before your
guys.
birthday, I really appreciate it. Thanks for being on with us. I know we did a great job tonight, so I appreciate you all being on. We'll see you all next week. Take care.